Okay, I started the recording. I'll go through this one more time, guys, for the sake of the recording. The bullish vertical spreads are the spreads that you are buying to go bullish. That means you're going long. That means you buy the lower strike calls, which you'll buy, and then you will sell the higher strike calls. What happens because of this is your risk is the total is that the difference between the strike prices, that is 120 minus 110, which is that is $10 minus the amount that you paid for it. Let's say you bought it at 115, you paid $5. So your risk is around $5. Okay. Whereas you had bought anything, guys? Okay. So the risk is very, so that is how it is, right? The risk is minimal. But look at the profit-wise, the profit-wise is also the same thing. But I'm giving an example because you're buying it at the mid price. Let's say if you bought it somewhere around $112, then what happens is, then what happens is you'll get more profit margins, $8 for the $2 risk that you're taking. So that is how it works. So similarly, the bearish vertical spreads is like, we also call it as short call credit spreads. What does that mean? You're betting that again, as I said before, the vertical spreads are always directional. So in the bearish, what you're saying is you're selling the lower call and you're buying the higher strike price. What you're betting is that the stop price will not go above 120. Let's take the same case of Apple. What you're saying is if you do a short call credit spread on Apple with 120, what you're saying is, hey, I don't expect this stock to go above 120. So you're betting it for the downward movement, and that's how you make money. And by the way, this is a credit spread. That means you're selling it, so you will get the premium upfront. Okay, for which of course the margin will be there. In this case, we have $110 to $120. That will be $1,000 margin for each contract that you buy. So if you have let's say you're buying 10 contracts, that means your account should have at least $10,000 to do this kind of trade. Does that make sense, guys? Okay. Let's move on. So that is called the long short call credit spread. Then similarly with put, guys. Put, always remember that in general terms, call means going up. If you're saying short call, that means you're betting it is going down. Similarly, long put means you're betting that it will go down. And if you're saying short put, that means you're betting it going up. So again, the long put debit spreads. Higher strike puts bought, higher strike put, long put debit spread is again higher strike put bought with lower strike put sold. Now, I wanted to tell you one thing, guys, here. Do you see, Ed, what you're saying is, let's take the case of Apple again, 110 to 120. You're telling that this stock will never go below 120. What you're saying is, at that time, you can buy a put, which is 120 puts, which you buy it, and then you can sell 110 puts. That means what happens is you're betting for that $10 move. That is one thing. Then finally, the short put credit spread. This is a very popular strategy which is used for making money. When they want to bet on stocks that are going to go up. What they do is they'll buy the lower strike put, and then they will sell the higher strike put. When you sell the higher price strike put, you're betting that it is going to go up. So anytime, let's say, take a case of Apple again, 110 to 120. If I buy a short put credit spread, what is going to happen? You're saying that, and you get a credit, let's say the stock is at $117. Now you get a premium of $3 for the 120 because you're selling it, right? So you get a $3. Now what happens is if the stock closes above $120, then you get to keep the premium, and then you don't have to worry about anything. This is called income generation, guys. People do this all the time. This is called the house playing. This is called the house playing on the money. They will play with the money And like, all this volatility and all those things, they don't care. All they care about is where the stock is on the expiration Friday, and if it's above the price they sold it or not. That is all they care about. So similarly for the call spreads and call credit spreads, and for the put credit spreads. So the credit spreads can be used for income generation, guys. Does that make sense? Any questions so far? No?
Srini, I got a quick question for you.
Yeah.
Normally what I noticed is when you have a debit spread, right? Both sides of debit spread on the same week or on the same month, there is a 90% that number. Do you consider that very high risky or low risk? I mean, because it feels like low risk, right? Because you're almost getting 85 out of 100. And the loss side is if the stock moves by $100 or 120, so your loss is $15. But if stock doesn't move, stay around, you're actually making 85. It's most of the Amazon and most of the stocks I noticed, it is that. I did play many times like that, but I didn't really put the calculation around it. So what do you think that strategy is really? I mean, throw me your experience, please.
I'm trying to recollect it in my brain what you said.
Okay, let's do that. Let's do that quickly, right? Let's say you sell Amazon 2100 and buy 22,000, and then Amazon 2100 you put and call, you both sell, and you buy 22,000 put and 2200 call. Normally, if you notice, it actually comes to, if you go for a month or like probably 2 weeks or 3 weeks, it will come almost 85 to 90% of the premium. Of the move, 85% of the move, you get the money back, especially volatile stocks, 85 to 90. That means your loss side is 10%.
You're talking purely about debit spreads, right?
Debit and both purely debit, correct. Both sides purely debit, right on the money, right on the money. Both sides, when you do both sides, I notice it's almost 85 to 90%. Does it make sense to, because stocks don't move really, right? Because to kill the options, they don't move like that, every time. But what's your take on that really?
My take is like, if you are getting, that is a very valid point. Even I've seen that. Basically, you won't get it 100% unless
of course, there is no way you get 100%
expiration day. That is very, very valid, because there is always a theta. If you understand how time decay works, right? The time decay works only on two things, right? The time decay works the most on the weekend before the expiration, and on a Thursday evening before this thing. So if you are saying 85 to 90% on a Thursday, I would close the spread usually, basically. If you want to, I would close the spread and take the profit and run with it.
Yeah, for example, 3200 spread, which I'm talking right now, right? Right now showing 80, okay? 80 credit basically. 80, actually not even 80. We're talking about 86 credit.
Okay, guys, this is Bharani. I like this discussion, except the fact that I'm not at all following anything. If we can,
let's continue what you're doing. We can talk about. I can talk this question later.
No. Okay, you guys are getting me wrong. What I'm asking you guys to do is open wherever it is, whatever it is, finance.yahoo.com or TC2000. Show me the numbers and then let us talk. Because Srini, I will tell you this also: bullish vertical spreads and everything that you're all this.
No, I'm planning to do that. Just I wanted to give this intro.
Okay.
We have to take an example and run through it.
Okay. So we'll come back to this later then, Srini. Let's go through this introduction lessons first.
Because then we'll the reason
why this will not help you.
Why I got confused is because the stock price is 115 of Apple, and we are just talking about two prices, 110 and 120 or 117 in between. Okay. Without saying, okay, what are we talking about? I don't know if we are talking bullish vertical spread, bearish. I don't understand. I mean, maybe others may already know it. I got nothing out of it. Just so I know.
Okay.
Hey, Srini, this is Didi. Can you let Tarun in? He's trying to get in. See if anybody else in the waiting room.
Yeah, I got him.
Next man.
Anybody else? That's it, right? Okay, that's good. Okay, yeah, basically you have a very valid point. We can talk about it with our system. Give me 1 minute. But before this, I wanted to quickly cover this so that when we are doing the stuff, right, we should know what we are looking at, okay? I'm going to look into my screen and I will show you all these things, okay? That's what we do. So this is the risk and the rewards again, how much you get and all those kind of things. So give me a minute. I'm going to share my trading platform, which is eTrade, and I'll try to show you all these things. Okay, that's 1 second. We'll take the same Apple calls and we'll do whatever we are talking about. Okay, give me a minute. Anything else you want to cover other than this? Credit spreads, any questions so that we can cover it while you are doing this? Hello? Okay. I'll be back.
No, I don't have any questions. Sorry. I don't know if others had it.
Continue with what you are doing, Srini. Then if anybody has questions, they'll stop you. Or, you know, if you need any more, they'll come out. Right? Otherwise, I think some people, if somebody doesn't understand, they'll go through recording. I think you covered all the directions.
Okay, I'm trying to. Okay, let's do this. Okay. Let me share again. What is that sound? Is it something from my phone or somebody's? Getting some voice continuous.
That's me, Srini, in the car. Sorry, I forgot I was not on mute.
Okay, no worries. Okay, let me share my screen again. 1 second.
I thought you guys had a timer on Srini not sharing his screen.
Okay.
I'll try that next time.
Yeah. Okay. Are you able to see my screen?
Yes.
Yes.
Okay. This is how pretty much an option will look like, guys, basically. Okay. Any trading platform will have something called as an option chain, where you will have a bid, you will have an ask, you will have an implied volatility change, implied volatility, open interest. I mean, these are all, you can have it additional, but the main thing is these things, okay? Now, if you go into this, there are different types of things. What I'm going to cover is the vertical, right? Now, let's take the case of Apple. So, because so far we talked about Apple, right? So, Apple is at 114.96. If you look at these spreads, I'm looking at this week's spreads, okay? It will have for every week, October 23rd, 30th, and all those things. So, now look at this. If you look at it, if I click on this, it will show up something like this. October 8, 108.75, 110. So I would say this. What you're telling here is my spread difference, how much is it? Let's say, since the price is at 110, then we'll take it 120. So how much is it? You see this? I told you the price is around $5, $5.10. That means the intrinsic value is covered in this. The midpoint of it, $5. So if you are putting $5 for this bid, the max you can make is $5. Does that make sense, Bharani, what I'm talking about for the debit spread?
Yes.
Okay, because the difference is 110, 120, the maximum profit you could make is the difference between the strike prices, 120 minus 110, which is 10. And what is the price you paid for it? It will be $5. So even if it goes to 120, you will be making only that additional $5. Okay, so that is exactly where you can do your risk reward ratio. For $5, you're getting $5. Is it worth the risk? That's one thing you have to think about. Okay.
So if the price is at 112, what happens?
If your price is at 112, and since it is not the theta is like, because this week expiration, theta may not be that great. So it will be like, okay, by the way, theta measures your volatility. Okay, guys, this I want to backtrack a little bit. A price of an option is determined by 3 things. One is the actual stock movement. The other one is the volatility. And the other one is the time. Okay, these 3 determine the price of an option. So the stock movement is what is called as the intrinsic value. For example, when you said 112, That means my lower strike price is 112. So it is 112, 112, so it will be $2. So the $2 will be my intrinsic value, and you will be having that much will be the minimum price of the option. Now your volatility and your time will be measured by something called as theta. So that the theta is one of the option geeks which is there. For example, if you say, let's say this one only, right? Strikes. If you see here, the theta for this is around 0.04. So if you had bought this spread 112 to 111.25, and your thing, it will be something like 2.04 or something like that. Okay, does that make sense what I'm saying? It will add to the intrinsic value or whatever. In this case, you will not even make the profit, but I hope you're getting the point what I'm trying to say, right? The theta will measure you the volatility and the time.
Yeah, I get that part. What I was asking, sorry, I was not clear in my question. Let us say at the time of expiry, right? 1 or 2 days on a Wednesday, right? Friday it expires, on the Wednesday it is 112. Okay, and if I am closing my position on this, so how much money do I make?
How much did you put?
$5, right? That is what I bought it, right? Between 110 and 120.
Right? So that means you are at a loss, right? Basically. See,
okay.
You are at a loss because now your option, your debit, your spread value would have reduced to $2.
Yeah, but he still yeah, you're right. But it still has a time value, right? He has a 3 days of time value.
But the time value theta, it depends, right? If it is this week, how much ever it is, that's what I was showing, depends on the theta, right? So the
and
theta,
minus the other one, other call also.
Minus then it will be 1.89 or 1.7, something like that it will be, Bernie, minus the theta value.
Okay, I'm still confused. So the stock price initially was 115. Okay.
Right. You bought it at 115, my friend. So that
yes.
you got it for $5, right?
Right.
Now, your spread is your price went to $112.
Yes.
You bought it at 115. It went to 112. So your spread value, the intrinsic value went down to $2.
Right.
So that itself. So now, in addition to that, as you get closer to the expiration, your theta will start increasing. You will start decreasing. That means whether I say should I increase or decrease, it's increasing. Basically,
so the amount that I get will start decreasing. I get that.
Exactly. So 2 minus something else. It will be like 20 cents.
$1.90, $1.80, whatever it is.
$1.80 or $1.70, like that.
Okay. Now I get it.
Got it? Okay.
So that is how it works. The purpose of this, like if the stock is going, okay. This only works if we are hedging, we are betting that the stock price goes up. Then it makes sense. Okay, got it.
No, either way, what happens is that you get closer to the expiration. Usually, the theta will significantly increase on a Thursday evening. On a Wednesday evening, also it may not be that much. But usually, as I was mentioning before, the weekend before the expiration and the week, the Thursday. The one, what happens is, why I'll tell you, because on Friday, fresh set of options come in for the next week. So these options will getting obsolete also. That is how it works. I don't know how the theta will get more violent. That's why you'll start losing your value of your thing. You won't even start getting your intrinsic value. That's what you have to be very careful. Okay.
Okay, continue.
That's why we keep telling, don't keep it for Friday. Sell it on Thursdays, right? That's what it is. Yeah.
So just to continue that topic, Srini, what is the best day to get out? I noticed that in my experience to getting out is a Tuesday. Is that correct or?
Not really. Until Thursday, it is okay. Thursday morning, Thursday. I would recommend you guys to get it out. If you think you have still some movement, get out on Thursday at any cost. Don't keep it to Friday. Because
basically Thursday is for the next week on one also you wanted us to get out Thursday, right?
No.
Oh, current week Thursday.
Only current. What I'm trying to tell is there will be some decay the week before. If possible, if you're shooting for a big time, that's why what we recommend is buy in the money calls so that you have a lot of intrinsic value in it, though it starts decaying, right? That's one thing. Right. So that is the reason why the intrinsic value is very, very important, especially when you're dealing with options. Especially even if you buy a debit call spreads, right? It is highly recommended, because if you're buying in the money calls, you're buying at a discount. If you're buying out of the money calls, you're buying at a very high premium. And if you're buying at the money, you're buying it at neutral. Okay. So you have to think about it, like how you want to do this and all that. Okay. Yeah.
Question for me.
So
can you hear me?
Now, yeah.
Hello? Question, since we're talking about Apple, right? Can we talk about the dividends, how they work? Because you're doing a spread, you're also selling a call. So let's say Apple announces the next dividend date and you're still holding that. How does dividend affect the spread?
That's a very good question. Dividends is like an income that comes in, and it doesn't play a major role, but it plays a role in the options world, because the OCC takes care of it for you, everything, especially the dividends and this one. But I'm not exactly sure to answer your question. Maybe I'll get back to you on that. Okay. I don't know how.
On the Sharath, if you are, is it Sharath to ask question?
Yeah, Sharath.
Yep.
Hey, Sharath, if you are asking the question about options have nothing to do with dividends, do you know, right? Option holders don't have
no, when
sellers
you
or holders.
when you sell and you get assigned, you're responsible for paying the dividends too.
When you sell, no, the seller.
You're doing a spread, right? So you're doing a 110, 120 spread. You're selling a 120 spread, and if you get assigned, you're responsible for the dividend.
Only if you are assigned, right?
If you get assigned, of course, very rare that is.
I mean, that is one of the things, right? That's what I thought, but I didn't want to neglect. So
I think it's not straightforward, but there is something else going on there.
What?
I'm saying it's not straightforward. I think you do have to, there's something, I'm not sure. That's why I asked the question.
No, basically what really happens, a lot of people, I know that because the stock price goes up, right? They expect it to go up. That is the reason they actually close it and reopen, basically. That's the one strategy I know people use.
1 second, Rampalli.
Yeah, go ahead.
What I'm trying to tell is, I know that the dividends play a role in the model, in the options model, when they do that. I don't want to mislead any of them in this group, but I will get back to you on that, how it works, okay? But it plays a very small role, but OCC always takes care of the option clearing committee. They take care of the dividends. The option prices are automatically included for the stock splits and dividends. That is my assumption. But let me get back to you on that, seeing that if anything that we need to do on that. Okay, that's what it is. So let's move on. So this is about the debit spread. Now there is another way which we talked about. It's called the credit spread, guys. So just like how we do the debit call spread, let's talk about how we do the credit spread. Credit spread is nothing but it's a reversal role. Let's say you are saying, oh, by the way, this is very, very important, guys. If you're doing your trading, if you click on the ask one, you will get your debit spread. Okay, this is the debit spread. How do you know? Because you are buying the lower one and you are selling the higher one. Okay. But if I click on, I don't know how it works on the other platforms. I'm assuming it's the same. It should be. Basically, if you look at this one, you will say you are selling 10 October 12, 112.5 calls, and this is 113. And if you see here, I get a 0.78 limit credit. That means you are selling this credit spread. Now, why I love these credit spreads is, number one, it gives me, number one, it doesn't need me to use the margins, because the margins are very less. For example, in this case, it's 112.5 to 1.25. Barely I need like what, $125 for this trade. So the $125, so then I can buy 10 contracts for $1,250. Still, you can make a tons of money if it moves in your direction. And second thing is, it allows you to be bearish also. And you can also, if you're at the later point of time, you think, hey, it is going really bad down, then you can sell off one of your leg and then make the other one run, okay? So you can do all those kind of things. You can adjust your spreads as it goes. This is called, you can play the trade as it progresses. Okay?
Hey, Srini, can you please pick Amazon? Apple is too low to do this.
Okay, whatever.
Because we recently did that, and I wanted to do it and I couldn't do it.
Okay. Okay, what did we do recently, Amazon? If I remember. Okay, let me bring up my chart.
I'll tell you.
So what we did is I remember now. We did it as 2871 and it was crossing this lead span B, and we knew that that week it will get up to this conversion line and it will not cross this. So what we did was we did a $25 credit spread, $25 debit spread here, which was from 3,000. It was from 3,000 to 3,025 or something like that. And we did a credit spread from 3,140 to 3,165. So because we knew that it is never going to hit the 3,140. So that is how we did that. So we played both the sides. Here we gave $10, and here we got a credit of $3. So totally we played the $7 for the whole trade. Does that make sense, Barney? So here, if I do this, Amazon, if you see here, let's say if I want the same thing, what did I do? So let's say that $25, is that what we did? All right, I don't, let me open up my, I have a spreadsheet here.
Okay, bought September 25, 30, 10,
I have
35.
3,010 to 3,035 debit call spread.
Yes,
and
for $10.
3,140 to 3,165, right? That's what we did. Okay, that's what we did. So we did a debit call spread. So you know how to play the debit. Now you know guys how to play the debit call spread, right? Let's say I click on this. I put that, what is that called? 3110 to 3135. Now the prices will be obviously different, but I'm just saying. So this is something we did, okay? 1717. And then we reversed this and we said for the other one, okay, let me show you, keep this like that. This is what we did. We did one leg of it. And then the other leg, we went a little bit over 3140, where, so if I go here, if you see here I will go here. I'll do this, then it will automatically give me the call spread. So here I went from 3140 to 3165. So I clicked on the bid now, okay? So this is what I did. So it gave me 11, in this case it's different. So I'm getting a credit here, so 1405. So that is what we did in that case. Now, why it is so high? Because it's in the money, or it's like, how much is the price now? Oh, it's already 3174, it's above this. So it is betting that you will lose money on this. So whereas in our case, it was below that, so we had $3 only for that. Does that make sense, Barney, what I said?
Yes, thank you.
So it's as simple as that, guys. If you know how to play spreads, there is another thing called as calendar spreads, which is very, very powerful, guys. A lot of people use it for money presses, okay? Have you guys heard about money press?
Is that where I can go and they will give me cash? I'm kidding. I don't know.
Yeah, you're right. What they do is, I think Rampali knowingly or unknowingly plays this. It's just a word for it. But what they do is, let's say Apple, right? Let's say Amazon. Amazon, it has revenue. When is its next earnings? Let's look at that. When is its next earnings, guys?
It's around third week normally. Third week of the.
Anybody can tell me when is the next earnings?
Third week of normally. They will do third week 10th month.
Okay.
Sorry, 10th month, 3rd week normally.
November 30th. Okay, something like that.
No, November 3rd
November
week, which
3rd.
is
Okay, that's fine. So
November
what you
3rd
can
week
do
is
is,
which is coming to 16 or whatever.
yeah. So what you can do is, instead of this, you can do a calendar spread here. What people do is,
Actually,
before see, about 4 or 5 years back, I believe, am I wrong? Maybe it's much more older than that. There was never weekly options. There were only monthly options. So what people do is they used
Sorry, Srini, just to give you the exact date, October 22nd.
October 22nd. Okay.
Yeah, you can see it's jumping from big time. It will jump from October 20 to 23rd now.
Thank you.
The prices will jump big time.
Yeah. Thanks. 1 second. Yeah, thank you. Before that, right? So there never used to be weekly options. So what people used to do, they used to sell the second month, the 2 months away from with the calendar spread. What they used to do is they used to sell second month premium. Okay, let me give you an example in this case, right? What is the calendar spread? Calendar spread is saying that I can sell one leg of it. I can use one leg of it on a different date and one leg and the other leg on a different date. For example, now since Amazon, how many of you believe Amazon will go up for the earnings?
I believe it.
Not bullish?
Yeah, no, I said I believe it because next month, October 13, 14 is the prime days. So people will spend all their money there.
There you go. He's very up to date on the prime days. Okay, that's good. Okay, so the way people play it, let's say that is like around, but it's not very lot of time. But I'm just, since we were looking at Amazon, usually the way they play the money presses, they do 2 months at a time, okay? So what happened, but in this case, we have 1 month, still that's okay. So what you can do is, let's say, what do you do? So see, it's already coming up here. When I do calendar spread, it's showing me October 2nd, October 9, October 9, 20, October 20, October 23rd. So which one do you want to play? So let's take this, October 23rd, which is the week of expiration. So what I'm going to do is, let's say right now it's at 3190. So what I'm going to do is, remember I told you the credit put spread is, it means that you're selling the higher strike put and you're buying the lower strike put. So what you're saying is, let's say right now the price is at 3170. So what I'm saying is, I will take this, wait a minute, what should I do now? I'm selling the higher strike put and I'm doing the lower strike put, right? So that means I'm going for the credit. So let's do this. So you see this? So so you got this. So this is like a calendar, right? So what I'm doing here, I will buy the October 30th, let's say October 23rd. And I'm buying the 319070 puts. But here, what I'm doing is I'll buy this week, which is October 9th, the next week, I will buy, let's say 3180. Is this a credit spread? No. 310 buy, sell, right? This is puts, right? Is this puts? Yeah, puts. So October 23, 20.
So you're doing the calendar right now, right?
Yeah.
Calendar price has to be same, right? I mean, at least in the terminology I'm talking about.
Okay. What I meant
don't have to be, but in a real terminology, the number has to be same.
Okay. So no, actually it's not a calendar spread. Sorry guys, yes, you are right. Actually, this is showing me wrong. So let's do one thing. What I'm trying to tell you is, let's buy this 3170 puts. Let's go back to the normal. Let's buy 2 orders. So what I'm going to do is either October 3170, I am buying these puts. That means I'm going for this. So how much is this? I'm paying $46. No, I'm buying, how much is it? October 30th. So that is like 179. Oh, wow. That's okay. Let's keep it like that. October, $179. And what you do is you go to this coming month. October 2nd, right? October 2nd, I will buy 3180. 3180, I am selling the put. So you are getting only $52 30-day limit day to open. You getting this? So the whole idea behind it is what will happen is, this is how guys collect premium, guys. So when they sell this time 3180, and if it closes above 3180, they will collect this premium $52.30. The whole idea behind it is, if you can get your put, which you sold it for, which you bought it for $179, if that can be covered in 2 to 3 premiums of every week you keep selling 3180, then you increase it to 3190, those kind of things. You keep on increasing your prices, right? But it will reach a point where your premium, your margins might increase. So at that time, you might want to move even your puts to upward. So am I being clear here, or am I confusing you guys? Anybody? The whole thing is you collect the premium weeklies, but you hold a protection for the longer term. That's what I meant to say. So every week you can sell your premium, but you can collect every week. You can sell and collect your premium, but you have a longer time protection. This, they call it as money press, guys. So basically, they will keep on adjusting it until they collect the premium. This they do it for very highly expensive stocks, and also the stocks that are big movers like Zoom, Tesla, and all those kind of things. Somebody's chatting. I would not be able to see the chat. You have to come out and tell me if you want. I heard some noise. Hello? Anyway.
No one is chatting, sir. I don't know.
Oh, I thought I heard some talk. That's why I was wondering. Okay.
Nope.
Okay. So that is pretty much it, guys. So the credit spreads are pretty same. Now I wanted to talk to you about something called synthetic positions. Have you heard about it? What is called synthetic? Anyone?
Yeah, I did it, but I told right.
Can you be a bit louder, please?
No, I heard it. I did it many times. Just that which one is what I do not. That's a little bit confusion. Otherwise, I've done all kinds of things before.
So, in other words, synthetic positions are something like which we call it. It's also called as like, you know, it's like you do multiple trades in such a way that you don't have any position at all. So basically, if you say, let's say you are at a $25 stock, you buy the long call and then you buy the long puts. Literally, you don't have any positions, right? Because you are on both the long and as well as on the short. So that is called a synthetic position. What is one thing that comes to your mind? Usually people play during earnings.
Make money both sides, right?
No. What is that strategy called? Straddle, right? One of the things,
Straddle,
buy on the same put and the short, right? And then one of them goes down. They know one of them will definitely go down and one will go down. But when you're taking the trade, it is definitely a synthetic position. That similarly in the spreads, we can easily create these synthetic calls, synthetic positions. For example, you do a long call spread, and then you do a long put spread, then you will be definitely in a synthetic position, right? But you, now tell me one more thing, guys. If you have a long call and then you have a short put, which one would you take? Any idea?
Long call and a short put?
Both means it's going up, right?
Yeah.
So what will you take?
Long call.
Huh?
I'll take a long call.
Why?
I'll take a short put. I'll explain you. I'll explain you.
There is a lot of time. And I can get out.
No. The reason why I'm saying it, long call and a short put are the same, right? Basically, long call is a debit spread, whereas the short put is a this one.
Credit kind of thing.
So for number one, right? So that is one thing, but you have to see which one is cheaper, right? Comparatively, based on the strike price and where you are, and there will be something called a skewing. So they will not be the same all the time. So they will be different, and you want to see which one is better for you and all those kind of things. You can do that. So we'll cover more in the next like episode. Maybe I'll also create a lot of blogs for this and examples and all those things. It will be very difficult to cover all in one session. But definitely my intention here is not to tell everything about it, but my intention is to provoke your thought process and to go and look at it, right? See what are the various things. So also there is a thing called as a box approach, where they do the same thing. They do both the long and the short so that they don't have any positions at all. So I would also recommend you to look at the box approach and see how you can do this. So one thing you got to understand, guys, is the more tools you have in your arsenal, it will enable you to play according to your situation. And options are very good in the sense you can definitely do this damage repair, right? Let's say something went out, then you can definitely do another way trade and get in and minimize the losses. That is one beautiful thing about options. So I would highly recommend going through the box strategy. It is like I would also I'm also planning to write a blog on that. It's very easier to explain it in writing rather than this, because I have to put an example and give it to you. That way we can go for that. Okay, yeah. I'll stop here. Any questions, guys?
Yes, before we stop, can we go through Rampalli's, whatever he was talking about Amazon?
Yeah, we'll do that now.
Yeah, and then once we quickly wrap this up, I have a question regarding something else not related to any of this strategy.
Okay.
Rampalli, wake up.
Okay, let's put it together. You are already on the system, right? Can you put a custom, or I don't know what is the best way for you to do on this Power trade? I did not use whole lot.
I cannot place the trade, but
you don't. We're not looking to place the trade, right? We're just looking to put the things together. That's all we are looking for.
Yeah, tell me.
So now you to pick the Amazon correctly. Now you pick the strategy. There is a strategy you can pick, right? Or you can make the custom also, which is Iron Condor, right? Was it what? No, it's Iron Condor, right? You're collecting both sides.
Okay, that's fine. Iron Condor, butterfly, Iron Condor. Yeah, tell me what you're doing.
Okay, let's do the. Let me tell you exactly. I know I'm very confused about
let's
this terminology.
I cannot. Do it vertical.
Okay, let's do like buy, sell 3100, sell 3100 both put and calls.
Both calls and puts.
Short both 3100 short.
Calls and puts, right?
Call and put, correct.
Okay.
And then buy 3000 put and 3200 call.
Buy
100 down, 100 up, basically, just to cover up.
3000 calls and 3000 puts.
No, 3200 call and 3000 put, basically. You're covering up, right? Basically.
100 calls and 3000 puts. Okay. So you are looking like you're bearish on this.
No. I sold 3100 call, 3100 put, and I'm buying 3000 put and buying 3200 call.
So you're buying.
I'm neutral, basically. I'm neutral. I'm thinking that it won't move. That's what my goal is.
No, but still it is bearish, right? When you are buying 3200 calls and you're selling 3100. See, usually when you are bullish, you buy the lower ones and you sell the higher ones.
Maybe you can put it on the spreadsheet quickly, so you can put it on the trade. Can you go to your spreadsheet maybe? On the right, you have, right? Outside, yeah.
Go down.
Just open a new sheet. Yeah. Now put there that is say 2100. Just say 3100, 3000, and 3200. I'll tell you. Can you put 3 rows like 330? Start with 3000. 3000. Just put the number 3000. Okay. Next 3100. Next row.
Oh, next row. Okay.
Yeah.
Okay.
3,100. Next row 3,200. Now on the 3,100 I put -1. No, 3,100. 100 put, yeah, there put -1.
Okay.
Next one -1.
Okay.
And on the top of this -1, take out that. You don't have that. On the right, go to the right now. Next. Yeah, put 1 there. And come to the bottom. Put 1 there.
The matrix, sir.
There we go.
B4, C6.
There we go. Yeah, that's it. So now what you're doing is you are selling. That's correct. There we go. That's what it is. Now, if you do the same spread on that, I'm looking at right now 86 is the move is 100. The stock has to move $100. But if it doesn't move, you make 86. If it moves, you lose 14.
Sold your 3,100. You bought your 3,200 calls. Okay. That means you are bearish. You would have got a spread of credit, right, for this?
Both. It's a credit spread, of course. $86 credit spread. This is.
Okay. So you're for the first one, you're betting that.
First one, I'm betting that it will go up. Second one, I'm betting that it will go down. So I'm basically betting that I'm neutral. If it stays anywhere between 13,150 to 33,050 by end of the week or whatever it is, normally 2 weeks, of course. I mean 1.5 week. I'll make 86. I don't make 86, as you know very well. It's not easy to close 86, but maybe 20s, 30s, 30, 40s. Basically.
So here you're saying you bought your puts, you sold your.
Can you give me the cost also?
3,100. You're bullish on the 3,100, right? For the put.
I can give you the cost too. You want me to quickly give the cost so you can put the cost also?
Actually, this is wrong, Rampalli. This should be 1 minus 1.
Why this is wrong? This is a credit spread. Credit spread both
credit
sides.
Spread, you always say
credit spread both sides. This is.
You said, hold on. You're right. I'm sorry, my bad.
So let me give you their numbers so you can put the numbers on the next. Let's put the next 2 columns numbers.
Okay.
Next 2 onto the right. Just on the same row on the right, we'll put the numbers. The way you put the call put, you put the numbers now. Okay. Let's start the number there. All right. Yeah. There nothing, right? Next one. You have to go to next cell. Because that's
column
you're not selling.
E2.
Yeah,
E2, okay. Sir.
E2. Right. E2, you are getting midpoint is 48. 49, 48, let's say 48.5.
What is 48.5?
That's a midpoint, bid and ask midpoint, that is. Okay. Now let's go to D. Let's go to D3. Go to D3. Your D3 is 156. Minus 156. D3 is minus 156. D3.
I'm sorry, I'm not following this.
D3 is minus 156. Yeah, that's right. Let's finish it, then you will understand, right? Now E3 is 81.5. E3. E3 is minus 81.5. Okay. Now D4 is 103.
D4.
Yeah. Now, if you combine all 4, you will see that.
Sir, just so you know, these numbers are nothing but whatever we did on the left side. Column BC lo ammina calls puts. What prices ikkada pettamu.
Prices ikkada pettamu ante. If you just sum of all 4, you will get 86 now. Can you sum of all 4? Just click the sum and just pick all 4. On the bottom, go to the bottom a little bit.
Choose any other cell and just sum all these.
Minus 156 minus 81.5, right?
Right.
Yeah, we already lost money.
244 minus 2.
No, we didn't lose the money yet. Let's do this.
It should be 0, right? What is it?
No, it won't become 0. There is no way.
Zero ledu.
Put it on D6. Let's say
E8, E9 ఎక్కడన్నా పడేయండి.
Put the cursor on the D6.
That's fine. That's fine. What are we trying to do?
What are it? No, that thing we are trying to do. Remember, you talked about debit spread, right? I'm talking about if you execute the debit spread, you actually get 90% of the value, almost 85% of the value immediately.
Yeah.
So debit spread, we are talking about 5. Remember, we were talking about 5 debit spread, right? Remember earlier? This I am talking about making it to 8.5, which is 85% of the 85% of the move. That is basically that. So,
yeah, that's what I'm saying, right? There is something called as pinning that happens on the final day. Maybe it has to do with that, but I agree with you totally. We get only 85 to 90% of the move on Thursday before the day. Only when you finish it off, especially you're talking about credit, right? Minus 156, minus 8.
Yeah, both sides credit. We are taking credit both sides.
Money that you're getting it from the credit, right? All those things will come to you when on the pinning on the Friday afternoon at 3 o'clock at Central Standard Time. If the prices closes above your stuff, then you will get it.
Can I requested, can you give it to me control once, please? Okay. Up.
Okay, Rampali, when I added up all those, it came to minus 86.
Correct. So you're getting 86 debit.
Yeah,
but either way, if it moves, you are losing max is 100. Remember that.
Have you waited until the Friday evening, 3 o'clock or something like that?
Yeah, if you wait until Friday evening, if it's 3,100, you get tons of money if it stays. If it goes to 33,000, you lose $15.
Yeah.
If it goes to 3,200 or 33,000 or anything below or anything above, you lose 15.
Yeah, that's the whole point, right? So if you don't want to wait until, see, there are traders like who pin. They wait. They only do trading on Fridays. They do pinning. They call it pinning. So they'll do is they'll wait and see where the stock is pinning. It's always pinning to a number, round numbers or something like that.
I think there is some problem. Don't worry about it. I'm giving up the remote control. Don't worry about it. So basically, the total is coming to 86 almost. So.
Hey, Rampali, we should do this on for October 16th and see.
That's correct. October 16th only I gave you.
Very good. Because 13th and 14th is their
I know.
Prime day.
October 16th I gave. So what I do here, Srini, at this point to cover up my losses so that the only time I lose at 3,000 or 3,200 to cover up, what I do is now I buy it at 3,000 and sell at 2,900. I buy it 3,200 and sell 33. That's my strategy normally. So I buy basically 3,200, sell 3,300 also. I mean, it most of the times works pretty decent actually for the especially.
That's a known strategy, right? If you buy the 3,100s, you will get that, right? Like
yeah. It's basically reverse to our what is that, man? I can't. Sorry, I'll get that my names right next time. Don't worry. Sorry for this.
So cool.
Because if I do with the math mentally, so I didn't have to remember the names because I didn't have to tell anybody.
Yeah.
We're talking about it.
I didn't know what is the price today. That's what I was like struggling to see. What is the price? 3,174 today. How did it come to 156? This is one contract.
It's one contract.
Too much
16th.
of
16th.
Too much of extrinsic value is there. Or what?
No, it's just, it's basically right now Amazon is. I just gave some number. Amazon is at 3,189 basically. So we could have gone to 3,200 also. It comes to the same thing. I noticed. Right now Amazon is at 3,190. Even if you go to 3,200, I can give you quickly the number. What is the debit spread for the credit spread for us?
I'm sure we can work it out.
Yeah, sure. Yeah. Thanks.
Right.
Yes. Same. That is also coming to 86 anyway.
Yeah. Everything, the credit spreads are standard. As long as the difference between the strike prices are the same, it will be the same.
Yeah. Right.
That is for sure. Because that is how it works. Yeah. Because all the thetas are all lined up, right? Yeah.
Yep. Mm-hmm.
So I think we are pretty much done here. Diva, are you here?
Yeah, man, I'm here. I stepped out for 5 minutes. I was trying to follow the last conversation.
So
I got
before
lost.
we go there, actually, we wanted to share something, guys, for those of you who are here. We wanted to little bit, we are thinking of going to a subscription model. And we just wanted to share with you, since you guys have been with us for a while, and we wanted to share with you and get your thoughts on it. But before that, Bharani, you wanted to say something that is not related. Is that something that you want to say now, or what is the deal? Bharani, are you there?
Probably.
Yeah, I'm here. It was related to what you wanted to say anyway. So that's good. I'm glad. Go ahead.
Okay. So sure. Diva, I'll let you share the screen. You can share.
Awesome. Do you want to sort of like pass on the control?
Yeah. 1 second. Not so good at this, but 1 second.
You have to say allow users to share the screens. That's an option.
I did. I don't know why it doesn't.
Let me see if it lets me. Oh yeah. You may have to give it.
It is under start video. It's under start video. I think allow users to share video.
Yeah.
I think first you should stop sharing your screen.
No, it doesn't need to stop. Basically, it doesn't. You just need to give other people to share. That's all.
Let me try now, man. No, still not there.
No, it's under share screen. Try under share screen, Srini. Try under click on the share screen. There should be an option. I think.
The recording, okay?
Yeah, sure, you can do that.